Hi all, welcome to TCM Education. We are 2 months on air and we want to thank those who are participating with us, watching our videos, and hope you're enjoying and profiting from our strategies. This is the topic today, working on strategies and how to improve existing strategies. There's always room for improvement when you are a day trader. Obviously when you are doing anything, I don't know, if you're running a pizza shop, there's always room for improvement. Definitely when you're day trading, there's always room for major improvement. So what is the improvement that I'm suggesting today? I've been working on improvements basically in day trading forever, and sometimes it's under your nose. You see it, you don't act because you're busy trading and your brain is not 100% on the money. So right now let's take a look at first what do I suggest that you should trade. Okay, everybody has his different strategy. I suggest you trade a unique set of stocks, very unique, that have unique attributes. For example, and I talked about this many times, but it's worth spending 2 minutes. So I want to trade stocks that are obviously only uptrending or downtrending if I want to buy, uptrending stocks if I want to short, downtrending stocks. But the list that I want to trade off is a list of super performers, only on a Monday. So being that Monday is over, let's see which were the super performers according to my strategy. So what is a super performer? A stock that closed up or traded at one point at least up 5%, and this is not a big deal. It's definitely not a super performer. The volume is over 4 million shares. That once it hits 4 million, it gets into this list. The range is above 6%, and this is quite an important number, because it means, if you remember in the past, I'm playing with these numbers. If there are a lot of stocks in the list, I'm going as high as 10%. And if there are no stocks at all in the list, I will go as down as 4 or 5%. But basically it means that the stock is a great mover intraday. So a 6% mover intraday, meaning the intraday range is 6%, means that a stock that's $100 moves up and down $6 from the highs to the lows, which means I can make, at least on paper, $6 if I buy at the 100% lows and sell at the 100% high, $6. Obviously it's not possible, but at least there is potential for dollars intra range, because that's what we are, day traders. So we live within the range. We want the range to be as big as possible. So if it is a $10 stock, it's going to be 60 cents. $100 stock, $6. A $50 stock, $3. So, and I don't want to deal with stocks under $10, because sometimes the liquidity, the volume, maybe it's a mistake, but again, I don't want to have too many stocks on the list, because if there are too many, I cannot focus on the best of the best. But sometimes I will start with $8. So let's take a look who were the candidates yesterday, and then I will talk about the strategy. But before the strategy does not apply to 6,000 stocks. It cannot apply to 6,000 stocks. I want to trade not 6, maybe 10. So this list is very shallow, but out of 6,000 stocks yesterday, only 6 fit the criteria. That's miserable number. So which means that those stocks have something very special about them. Let's discuss. So Vape gapped up, I don't know, 1,000% in the pre-market, because they're getting an infusion of up to $1.2 billion made of warrants and Bitcoin, and that's the Binance, not Bitcoin, the Binance, some kind of a Binance form of Bitcoin, which is a stable coin. And this is obviously super important for this company that had absolutely no business until the day before yesterday, and they had went to a split a year ago, so the liquidity is terrible, and they have only 600,000 shares trading. So that's how a stock can fly so much without basically the stock is totally out of control. And if we look at the chart, let me bring in the chart, you can see that the stock is able to move $10 in 3 minutes. And a stock that can move from 77 to 55 in 10 minutes, that's a quarter of its value or a third of its value, you know that something wrong. Obviously, the spreads are huge, so that's not something that I would suggest that would day trade or get involved with. Although there can be amazing risk reward here, but the risk is uncontrollable. Let's move on. So that's number one. Number two is another stock that pretty much did the same thing. Some news. I think it's also a former either SPAC, or I just didn't have enough time to inquire into this stock. So it was $2. It gapped up. It's okay. You can see the same secure strategic 50 million equity line to accelerate AI driven. Again, because of the price, which is under $10, I can see it myself only when it breaks $10. So I'm gonna forfeit this one and move to the third one. So Celcuity, that's a biotech stock that works on a breast cancer. And now let's see what I mean when I'm talking about the strategy. So you see this stock, it has a huge 200% gap up, then it comes down and up, and then it sits, as you can see here. You can see this perfect resistance here at 40. So the stock banks this 40 level, and normally what do? You buy the breakout over 40. And what is the stop loss? You look at the chart. At the beginning it was I don't know, 40 or 50 cents. Then it became more than $1, and let's face it, it failed. So any move towards 40 was either a spike up and immediately moving down, or it collapsed at one point. So again, it looks great. 40 is a tested level. You could have seen the buyers and sellers fighting at 40. I've seen it myself, and being that this is what I've been trading for many years, a perfect pattern that's almost a triangle before it breaks down, but at one point it is a triangle. Let me draw it to you. So it has a triangle breakout here at 40, and then the triangle collapses. But let's see what we can do, which is way smarter. Now if you wait and observe this chart, you can see that the stock at one point trades down as low as 38.30 and hits 38.30 for a period of more than an hour. So now take a look. It starts trading at basically what is the time here? After nearly 12 noon, at 38.30, and basically moves sideways for more than an hour. Okay, nearly an hour, and then breaks and then comes back. So the deal is as follows. Instead of buying at 40 and using 38.30 as the stop loss, why not buy at 38.40 and use 38.30 as the stop loss, give or take a couple of cents under? What is the difference here is the risk is 0, or in this case 1/3 of 1%. Let's call it 15 cents, so it's 0.5%. You buy a $20,000 position, that's 700 shares or 650, and you risk $100. But it's not quite clear, quite right with this stock, because this one is spready as well. But let's ignore the spreads, because most of the stock that we are trading don't carry any spreads, if at all. And here we have a 0.5% risk on the position, and the position can be $20,000, $10,000, $5,000, or $50,000. It's your position, you decide. But the risk is the same, is 0.5%, no matter how big the position is. Assuming that, again, the liquidity is good, and again, we're trading only liquid stocks, and again, to enter this list, you must at least have 4 million shares. So again, yesterday this stock traded 27 million, but it has its issues with spreads. Having said that, you buy it at 38.40, you risk 10 cents plus the slippage, let's say 15 cents or 20 cents, which is 0.5%, and now you're looking totally different. Now, if it breaks 40 and moves up $2-3, then you have a unbelievable once, I don't want to say in a lifetime, because if you keep on with this strategy, it's not going to be once in a lifetime. You're going to have an amazing risk reward intraday. So you buy a $20,000 position, you risk $100, and you may get 10 to 1, sometimes 20 to 1. Okay, 20 to 1 means a 10% move, and a 10% move is not a big deal for this stock, because the target is always for us the highs of the day. So highs of the day are 46, so it's not a big deal. Again, this one failed, okay, but there's a difference when you fail, you lose 0.5%, versus when you lose 3% per trade. When you lose 3% per trade, you feel it in your pocket. When you lose 0.5% per trade, that's meaningless. You can lose 6 times 0.5%. Obviously, that's not our intent. That's why we're trading this very, very close list of stocks that have something very special to them. Their ability to move a lot intraday. Okay, I hope it was clear, this example. And again, I'm not going to dwell into management, because I know that this is very personal. How much you buy, how do you manage? I'm just going to talk about the real opportunity. I talked about the real opportunity, which is observing the support, not the resistance. So you buy as close as possible to support and ignore the resistance. If it gets to the resistance and breaks out, perfect. If it dives under the support, you lose 0.5% or a very, very small amount. That's the whole deal. Just to decrease the level of risk. And if a trade works, and why a trade won't work in such a stock, this is where the big winners are going to come from. This type of setups. Okay, let's move to another example. Sarepta Therapeutics. Okay, and again, why I'm looking at Sarepta Therapeutics? It's on the list. Now, it's possible that the stock is coming into the list late in the day, and I'm missing the opportunities. It's possible, okay? So if the trade is late in the day and I don't have the pattern, obviously I can use other strategies. But if I can observe this strategy, let's use it. And now, where can I observe it? First of all, I can observe it and must observe it and look for it at round numbers, okay? If a stock like this is banging like it is here near round numbers in the morning session, I may look, and again, all you need to do is observe. If you observe, you can act. So you can buy Sarepta Therapeutics at 12.15, and the stop loss is 12.07, minus 2 cents. And if you're lucky, it goes from 12.15, risking 7 cents, to 13 or nearly 14 at one point. So the risk reward is unfathomable. I mean, it's like nothing like this can happen to you ever. Okay, so and this is the breakthrough of this strategy, where you don't control the risk reward, you control only the risk, and you need to, by definition, the average risk trades of your trades, and let's say you take 100 trades per month, and on a normal level you have a risk of 2 to 3%, and here you're going to take 100 trades per month, on the best stocks, and your average risk is going to be 0.5%. So statistically, it's going to be, I hope, that for some of you that are going to implement this strategy, it can be a breakthrough, and I hope it will be a breakthrough. I know that the numbers are supporting. Okay, so again, first opportunity here. Well, let me draw it again. At 12.07, where do you buy? Above it, 12.10, 12.12, 12.15. Obviously, you need to buy as close as possible. That's the goal, because then the risk is going to be as little as possible. And if you fail, and let me show you an example where we fail, okay, or you fail, okay, this is the 12.83. So this is the support here at 12.83, and it breaks down. So first, let's say you buy it at 12.83, it goes up 15 cents, and then it breaks down. So how much do you lose? Okay, you lose 5 cents. You can obviously move the stop loss to the entry after 1% in the money. That's the strategy that I'm doing or used to do. Okay, but let's say you didn't have the time to move the stop loss into the money, and you lose the 10 cents times 0.5% times the $20,000. That's $100. Or if it is a $40,000 position, twice as much. Or if it's a $5,000 position, I don't know the math, so you lose $25 or whatever. So again, that's none of anybody's business how much you buy, because you're in control, and worst case scenario is already built in. So your worst case scenario is 0.5%. And take a look at another example. Now we are sitting at 12.50. Now the stock comes down, and here banks its head to 15 minutes at this 12.50 level. Okay, so now if you exercise the strategy and you buy at 12.55 or 12.60, okay, you end up from 12.50 at one point at 14, and it closes at 13.80. So you have $1.30 on 10 cents of risk. That's 13 to 1. And if you have this type of risk reward, obviously you can buy more than 20,000 per position. But let's say you buy only 20,000 per position. And what is basically the reward here? It's 10%. The reward is 10%. It's $2,000 on this trade, which I hope nobody is objecting in delivering a $2,000 trade on a $12 stock, while sometimes you won't even look at it because it's a $12 stock. Now let's take a look at another example, and then I will show you the real good example. And there are examples almost on a daily basis. So this is a super microcomputer. Okay, so again, how do you look at super microcomputer? It has a huge gap up. It's very strong versus the market, and now it's up to you to look at the stock. Now, if you don't looking at the stock, obviously nothing good will happen. Okay, but you need to look and observe support levels. Now, if you can observe the support level of 56, the reward is again 8%. If you don't observe it at 86, you observe it at 56. If you observe it at 50, 57, 50, 60, and the VWAP, good. Then if you observe it at 58.20, you lose. How much do you lose? Again, the same strategy. Okay, so it's a $60 stock. You risk as much as 30 cents. That's your worst case scenario, and you lose 30 cents here. So big deal, you lose 0.5%. Okay, so you're not going to lose 1% here. The liquidity in a supercomputer in SMCI is amazing. Now again, why does this stock close at the highs of the day? Not all the stocks closed yesterday at the highs of the day, because it had something special about it. That's why it entered the list of 6 stocks out of 6,000 that we are working with. And again, we can easily increase the number of stocks in the group. Now let me show you because I promise most of the time to finish all my videos in 15 to 20 minutes. I always lie. Sorry about that. Let's look at basically the best trade that I've seen over the last couple of days using this strategy. Take a look at this one. This is amazing. Nothing else. So CRI is the worst stock that traded Friday above $10. It's down like at 1.25 or 30%. Nobody's buying Oshkosh fashion because they're expensive, and they're buying cheap imports or whatever they're buying for the children. I don't need to dwell into that. On top of that, the tariffs are hammering this company, so it's down 30% on earnings. That's horrible. But then this pattern is known to everybody that day trades. This is a bear flag formation. Hold on a second, not this one. You can see this is a perfect bear flag formation. So basically what do we want to do most of the time is take the breakdown. But the stock won't break. Okay, why won't it break? I don't know, but it won't break. So if you observe and you have this strategy that I'm talking about it right now with you in your like glued to your brain, you say, okay, the short trade may not work. Let's buy at 23.60. 23.6 buy. So we're buying, and the risk, what is the risk? 12 cents. Stop loss is 2 cents under 23.50. So we have a 12-cent risk, again 0.5% of the $23 tag, and look what happens here. So the stock moves up nearly $3. So at one point I think it went up more, over 27, yeah, over $3.50 I think. So it's 23.50. Here it is over 27, nearly $4. So the stock goes up $4 on a 10 cent, 15 cent risk. That's 20 to 1. It's not like 10 to 1 or that's what. Now I agree that 20 to 1 is highly unlikely to happen every day, maybe not every week. But if it happens once a month, okay, that is stunning win that will add to your 3 to 1, 5 to 1, 4 to 1, and you're going to lose 1/2. So let's say that you are terrible, okay, at what you're doing, and you lose 5 in a row. 5 in a row is 2.5% of losing, and eventually you're going to take a win, and the win will be 3%, and the second win will be 10%. So the losses will be covered very, very quickly, assuming you're not doing mistakes. And if you're doing mistakes, you can get in touch with us and we can help you improve on your strategy. Okay, because it's super easy to implement, not very easy to see. Okay, it's either you see or you don't see, but the implementation, once you see, it's very easy because you were trading very liquid stocks. You can use a limit order or a market order to enter the trade, and you have a stop loss in the platform, not a mental stop loss or any other visionary stop loss. No, you have a stop loss in the platform, couple of cents under the support level, and if you lose, you lose 0.5%. That's the strategy. Okay, so I talked for 25 minutes. Instead of my max allotment, which is 20, but I hope it was clear enough. And guys, if you have any comments, love to hear comments about what I just talked to you about. Do like, subscribe, share this content with your friends, and if you're interested in our mentorship, do email us. And thank you for being here, and we'll see you, of course, in our next video.